Do you actually know what happens to your money the moment you make that final mortgage payment? Most people spend decades working toward that goal, dreaming about the day they own their home, free and clear, but nobody ever sat them down and explained what that decision really costs them before they get there, or what it could cost them after. Today, you are going to walk away with a completely different perspective on paying off your house, what the banks never tell you, what the hidden traps look like, and how to make sure that if you do pay off your mortgage, it actually changes your financial life instead of just rearranging the furniture. Here's the first thing worth understanding. The mortgage system was not designed with your wealth in mind. It was built around a structure that keeps banks profitable for decades. Think about this. If you borrow $300,000 at 7% over 30 years, you end up paying back roughly $718,000. The bank made more money off your house than the house actually cost you. That is not an accident. That is the design. The monthly payment model is intentionally built so that most people only see the number due each month and never calculate the total price they are paying over time. Once you see that number, the whole conversation about whether to pay it off early takes on a completely different weight. Now, should you pay more than the minimum every month? Honestly, yes. In many cases, that is a smart move. Every extra dollar you put toward principal reduces the total interest you pay and shortens the life of the loan. If you have the cash flow to do it without sacrificing your emergency fund or retirement contributions, paying above the minimum is one of the most straightforward ways to save tens of thousands of dollars over time. The key word there is sacrificing. Throwing every available dollar at the mortgage while leaving yourself cash poor is where people run into serious trouble. And here is something that does not get talked about nearly enough. Paying off your mortgage does not mean your housing costs disappear. You still owe property taxes every year. You still need homeowners insurance. If you live in a community with a homeowners association, those dues keep coming regardless of whether your mortgage is gone. People have actually lost their homes over unpaid HOA fees or property tax debt even after paying off the mortgage entirely. So before you celebrate zero on the loan balance, make sure you have a plan for those recurring obligations because they are not going anywhere. Here is the big psychological trap that catches people off guard. A lot of homeowners pay off their mortgage, feel that wave of relief, and then within a year or two, their lifestyle quietly expands to absorb the freed-up payment. New car, kitchen renovation, more vacations. Before long, the financial pressure feels exactly the same as it did before, just with different labels on the expenses. The mortgage disappearing does not automatically improve your financial life. What improves your financial life is what you do with the money once the payment is gone. Think about what that monthly payment actually represents as an opportunity. If your mortgage payment was $2,200 a month and you redirected that into investments, earning an average of 7% annually over 15 years, you are looking at somewhere in the range of $680,000. Not from earning more, not from a side business, just from stopping one payment and pointing it somewhere intentional. The math is right there. But the math only works if you automate that redirect before your lifestyle has a chance to expand into the space. There is also a version of this that goes quietly wrong in a way most financial content will never show you. Owning your home outright sounds like ultimate security, but a paid-off house is one of the least liquid assets you can hold. You could have $500,000 in home equity and $12,000 in savings. On paper, your net worth looks strong. In real life, a major medical bill, a job loss, or an expensive repair creates a crisis because your house cannot write a check. This is what financial people call being asset rich and cash poor, and it is far more common than people admit. The answer is not to avoid paying off the mortgage. The answer is to treat the payoff as a foundation, not a finish line. Once that payment is gone, the next move is building liquid, diversified assets above that foundation. Automated investing, brokerage accounts, Income sources that do not depend entirely on one employer. The house gives you a lower financial floor, meaning the minimum you need to survive each month drops significantly. That is powerful. But only if you build upward from there instead of letting new expenses raise the ceiling right back up to where it was. One more thing worth naming. When your mortgage is active, your job holds a certain kind of leverage over you, whether anyone says it out loud or not. Your house requires a payment. The payment requires income. And that reality shapes the decisions you make at work, the conversations you have or avoid, the risks you consider or quietly file away. When that obligation is gone, the dynamic shifts. The job becomes more of a choice than a requirement. Some people stay in the same role for years because they genuinely want to. Others realize pretty quickly that they had been tolerating things they never had to tolerate. Either way, that clarity is something money alone cannot buy. Research consistently shows that homeowners with no mortgage report meaningfully higher levels of financial confidence and life satisfaction compared to those still carrying mortgage debt, even when income levels are similar. What people are responding to is not just the balance sheet, it is the absence of the weight. So here's the real question you need to ask yourself before making any decision about your mortgage. What is your plan for the money if you do not pay it off early, and what is your plan for the money the day after you do? Because without a clear answer to both of those, you are just reacting instead of building. Here's what I want to leave you with today. Paying off your house can be one of the most powerful financial moves you ever make. It can also be one of the most expensive if you do it without a strategy, without liquidity, and without a plan to redirect that freed up cash. The house is the floor. Your job is to build everything above it. Now I want to hear from you. If your mortgage disappeared tomorrow and you suddenly had that full monthly payment back in your pocket, what would you actually do with it? Would you invest it, keep it liquid, or has life already shown you how fast that money finds somewhere else to go? Drop your answer below, because this is exactly the kind of conversation that helps everyone think more clearly about this. If you got value from this video, or if something here made you think about your own situation differently, please give it a like, subscribe to the channel, and ring the bell so you never miss the latest investing insights. It actually helps more people find this content, and there is a lot more coming that you are not going to want to miss. See you in the next one.